Hi, it's Aaron with Churchill Mortgage, bringing you another market update. Mortgage interest rates retreated even further from their 2019 lows as the Russian invasion of Ukraine escalates and grows even more uncertain. In addition, there were other big developments here at home that erased a good portion of the recent rate improvements we've seen. So let's go ahead and break that down, see what happened, and what to look for in the weeks ahead. The Ukraine Russian war has escalated, and the outcome remains highly uncertain. No one knows if, when, and how this will end. And when the world experiences tense geopolitical moments, well, it drives what is called a safe haven trade into the relative safety of the US dollar and other US denominated assets like treasuries and mortgage backed securities. Now, last Monday and Tuesday, interest rates moved sharply lower, which was good news, with the 10-year note declining from 2% down to 1.69, and mortgage rates also improved nicely, but the gains were not in lockstep with the ultra safe haven of the Treasury market, meaning when the world is highly uncertain, Treasury rates move faster than home loan rates. Now, the longer this war continues, the longer we should expect mortgage rates to move higher. In addition to the Russia-Ukrainian conflict, last Wednesday was a bad day for bond rates, which gave up a sizable portion of their multi-day rate improvements because of the comments from Fed Chair Powell, who provided his semi-annual testimony before Congress. Now, what he said was, reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. Now, that was his prepared testimony on March the 2nd. In addition to that prepared testimony, he also reiterates the Fed's desire to remove mortgage-backed securities from their balance sheet. Now, they currently hold 2.7 trillion of mortgage-backed securities on their books. And if the economy remains strong and can absorb multiple Fed rate hikes, then the Fed will try to become a seller of mortgage-backed securities. And of course, the mortgage-backed securities market didn't like these words despite all the uncertainty in Ukraine, and home loan rates shot higher in response. In addition, Powell said the near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war, the sanction, and of events to come remain highly uncertain. Now, that's going to make making appropriate monetary policy in this environment require a recognition that the economy evolves in unexpected ways, and the Fed will need to be nimble in responding to incoming data and the evolving outlook of the events to come. Now, here the Fed is telling us the uncertainty in Ukraine could lead to fewer rate hikes. Now, stocks liked it and soared higher, but that was at the expense of mortgage rates. And lastly, the Fed essentially told Congress that it expects a quarter point hike in a couple of weeks. This removed the uncertainty that the Fed may go with a half point hike. Stocks liked it, bonds did not, rates shot higher again. And last but not least, let's talk about soaring oil prices. Oil touched $130 a barrel on Monday, and if there ever was a time to have high prices be transitory, let's all hope this dramatic increase in the oil price proves to be short-lived. High energy prices are an economic killer, and it's already weighing on consumer sentiment. And should it continue, it will weigh on consumer spending, which obviously makes up 2/3 of our economic growth. Now, the Federal Reserve will be factoring in the high oil price and its economic impact as they consider rate hikes and ultimately shrinking their balance sheet. Now, the purpose of the Fed rate hikes are designed to slow demand and thus lower prices. And if the consumer retreats on their own due to higher energy prices, the Fed may not be able to hike as aggressively as they intended when the year began. So the bottom line is this new Russian-Ukraine war changes everything. If you're considering a refinance or purchase transaction, now is the time when there's a lot of uncertainty. And even if we have better days ahead, we should be expecting somewhat higher rates in the short term.